What if I told you that the next economic collapse won't destroy the banks, won't crash the stock market, and won't bankrupt corporations, but instead, it's going to bring entire governments to their knees? Would you believe me? Because right now, as you're watching this video, the clock is ticking toward the biggest sovereign debt crisis in modern history. And if you don't understand what's coming, you're going to lose everything you've worked for. But here's the thing, I'm going to show you exactly how this happens, why it's inevitable, and most importantly, how you can protect yourself and even profit from it. So if you want to stay ahead of this financial disaster, hit that subscribe button right now and turn on notifications. Because on this channel, Monetary Archaeologist, we dig through the ruins of past economic disasters to predict the future. And trust me, you don't want to miss what I'm about to reveal. Let me ask you something. Have you ever noticed a pattern in how economic crises unfold? Because there's a secret that the financial elite don't want you to know. Every single time there's a major economic crisis, the next one always hits whoever bailed out the last one. It's like a game of financial hot potato, and the bomb keeps getting bigger each time it's gassed. Think about it. When a crisis happens, someone has to absorb the damage, right? Someone has to take the hit. And whoever takes that hit becomes the weak link. They become the next domino waiting to fall. This has been happening over and over again for the last 30 years, and once you see the pattern, you can't unsee it. So let me take you on a journey. We're going to travel back in time and watch this pattern unfold right before your eyes. And by the end of this video, you'll understand exactly where we are in this cycle and what's about to happen next. Let's rewind to 1998. Picture this. There's a hedge fund making absolutely insane amounts of money. I'm talking about returns that made every banker on Wall Street drool with envy. This fund was called Long-Term Capital Management, and it was run by some of the smartest guys in finance. We're talking about Merton, Scholes, and Black. If you've ever traded options, you know these names because the Black-Scholes options pricing model is literally named after them. These weren't some random guys gambling with money. These were Nobel Prize winners, literal geniuses, the best and brightest minds in economics. And they had discovered what they thought was the holy grail of investing, a strategy that made tons of money with supposedly zero risk. Now here's something you need to understand about finance. When someone tells you they've found a way to make massive profits with no risk, run the other way. Because that risk doesn't just disappear. It's there. It's always there. It's just hiding in the shadows, waiting to strike. So what were these geniuses doing? They were running something called arbitrage trades. Let me break this down in the simplest way possible. Imagine there are two identical products being sold in two different stores. One store is selling it for $10, the other is selling it for $10.50. You could buy from the cheap store and sell to the expensive store and pocket the difference. That's arbitrage. You're just exploiting tiny price differences. Now, long-term capital management was doing this with stocks, bonds, and currencies. They found things that were temporarily out of sync with each other. For example, look at Google stock. Google has two different share classes, right? GOOG and GOOG-L. Over the long run, they move together perfectly because they're shares of the same company. But if you zoom in close enough, there are moments when one moves slightly different from the other. When that happens, you can play both sides. You buy the one that dropped a bit and you short the one that went up a bit. Eventually, they come back together and you make money on the difference. And here's the kicker. When you short one and buy the other, the money from the short pays for the long position, so you're not even using your own money. It's a free trade. Sounds perfect, right? There's just one tiny problem. You're only making pennies on each trade. A few cents here, a few cents there. That's not going to make you rich. So what do? You leverage up. You borrow massive amounts of money to make these trades bigger. If you're making 50 cents on a trade, but you borrow $1 million to do it, suddenly that 50 cents becomes meaningful.
That's exactly what long-term capital management did. They borrowed enormous sums of money to execute this risk-free strategy. And for a while, it worked like magic. Money was pouring in. Everyone wanted a piece of this fund. The returns were incredible. But then 1998 happened, and everything fell apart. See, their whole strategy depended on one assumption, that the prices would eventually converge, that the temporary differences would disappear. But what if they don't converge right away? What if they diverge even further? That's exactly what happened. The prices that were supposed to come together started moving further apart. And because these guys were leveraged to the moon, they started losing massive amounts of money. They were getting margin calls. They were forced to close positions at the worst possible time. And here's where it gets really scary. When they started selling, it made the problem worse. Their selling pushed the prices even further apart, which hurt other traders doing the same strategy. So those traders had to sell too, and their selling made it worse, and on and on. It became a death spiral, a financial avalanche. And very quickly, this wasn't just about one hedge fund anymore. The entire global financial system was at risk of collapsing. So what happened? The Federal Reserve stepped in. But here's what's interesting. The Fed didn't print money. They didn't cut interest rates. They didn't bail anyone out directly. Instead, they made a phone call to the big banks, and they said, "Hey guys, you need to fix this. This is your problem now." And the banks did it. They got together, pooled their money, bought out long-term capital management, and slowly unwound all the positions. Crisis averted. Most people never even heard about it. If you want to dive deeper into this story, there's an amazing book called When Genius Failed by Roger Lowenstein. It reads like a thriller. Highly recommend it. But here's why this matters. This moment, this bailout, set a precedent. It planted a seed. It showed that when things get really bad, someone will step in to save the day. And it established the pattern I told you about. The banks absorbed the crisis from the hedge fund, which means if the pattern holds, the next crisis would hit the banks. Fast forward 10 years to 2008. You know this story. You lived through it. The great financial crisis, the housing market collapse, banks failing left and right, the whole economy on the brink of total collapse. But let me tell you something most people don't understand. The media talked about subprime mortgages and housing bubbles, and yes, that was part of it, but that's not why the banks almost failed. The real reason was something called the repo market, and almost nobody talks about this. Here's how it works. Banks run out of cash all the time. It's normal. At the end of each day, some banks have extra cash, and some banks need cash, so they lend to each other overnight. But you can't just hand over billions of dollars with nothing in return, right? So the bank that needs cash puts up collateral. They say, "Here, take these mortgage-backed securities. Give me cash. Tomorrow I'll buy them back from you." It's literally a pawn shop for banks, the biggest, most sophisticated pawn shop in the world. And it works great as long as the collateral is good. But in 2008, that collateral went bad. Everyone realized that these mortgage-backed securities were filled with loans that would never be repaid. They were toxic, worthless. And overnight, banks stopped accepting them as collateral. Imagine you're a bank. You wake up one morning and you need cash to operate. You go to other banks with your collateral and they all say, "No thanks, we don't want that garbage." What do? You're done. You fail. That's it. That's why banks started dropping like flies. Bear Stearns, Lehman Brothers, Washington Mutual. They couldn't get the cash they needed to survive another day. So the government stepped in with the bailouts. But who paid for those bailouts? The taxpayer. You and me, regular people. Now, I'm not saying you saw a line item on your paycheck that said bank bailout tax. It didn't work like that. Instead, the government took on massive debt. They made promises. They created obligations. And over the next 10 years, regular people paid for it in sneaky ways. Your groceries got more expensive. Your rent went up. Your healthcare costs skyrocketed. Good jobs became harder to find. The value of your savings eroded. All of this happened because the government decided to save the banks by pushing the cost onto regular people. The taxpayers absorbed the crisis, which means, if the pattern holds,
The next crisis would hit the taxpayers. Now we get to 2020, and I know what you're thinking. You're thinking about the pandemic, right? The virus, lockdowns, all of that. But here's what they don't want you to know. The crisis actually started before any of that. Go back and look at September 2019. Look at something called the repo rate. You'll see it spiked hard. The exact same warning sign that appeared before the 2008 crisis. Banks were having trouble again in the repo market. But this time, it wasn't because the collateral was bad. This time, it was because the government had borrowed so much money that it sucked all the liquidity out of the financial system. There just wasn't enough cash floating around. Why had the government borrowed so much? Because they were still dealing with the consequences of bailing out the banks in 2008. They had taken on all that debt, all those obligations, and now it was coming due. The chickens were coming home to roost. The repo market was flashing red. Banks were struggling. And then, conveniently, 2020 happened. I'm not going to say the word because YouTube doesn't like it, but you know what I'm talking about. And that event gave policymakers the perfect excuse to do the biggest bailout in human history. They printed trillions of dollars. Trillions. Money that didn't exist suddenly appeared out of thin air. But here's the interesting part. This time, a lot of that money went directly to regular people. Stimulus checks, unemployment benefits, small business loans. The government was bailing out the taxpayer. Now, don't get me wrong, I'm not saying regular people came out ahead. Most of that printed money still went to big corporations and banks. But enough went to regular people to create the appearance of a bailout. The government wanted people to keep spending, keep consuming, keep the economy moving. Why? Because the alternative was a deflationary death spiral. The taxpayer was facing an economic depression worse than the 1930s. Unemployment would have skyrocketed. Prices would have collapsed. Businesses would have failed by the millions. It would have been catastrophic. So the government stepped in and absorbed the crisis. They took on even more debt. They printed even more money. They expanded their balance sheet to levels never seen before in history. Which brings us to today. And if the pattern holds, we know what's coming next. Let's review the pattern one more time because this is crucial. In 1998, a hedge fund failed and the banks absorbed the crisis. In 2008, the banks failed and the taxpayers absorbed the crisis. In 2020, the taxpayers were failing and the government absorbed the crisis. So, who's next? Who absorbs the government's crisis? Who bails out the government when the government fails? The answer is the Federal Reserve, the central bank. And this is what's called a sovereign debt crisis. Here's what that means in plain English. The government spends more money than it takes in through taxes, way more. So it has to borrow the difference. But borrowing money means paying interest, and the more you borrow, the more interest you owe. And eventually, you reach a point where you're borrowing money just to pay the interest on your previous borrowing. It's like if you made $100,000 a year but spent $200,000. So you put everything on credit cards. And you keep transferring balances to new cards to get low introductory rates. But you can never pay down the principal. You can only make minimum payments. And meanwhile, you keep spending more and more. Eventually, you run out of credit cards. You can't transfer anymore. The interest rates spike, and you default. That's where the US government is headed. On the current path, with no changes, the government will default. That's not my opinion. That's just math. So what happens then? Who saves the government? The Federal Reserve, the central bank. And they do it by printing money, lots and lots of money. This is what always happens throughout history when governments face sovereign debt crises. The central bank comes in and buys up all the government debt. They call it quantitative easing. They call it yield curve control. They have fancy names for it, but at the end of the day, it's just printing money. And when you print massive amounts of money, you get inflation. Your purchasing power gets destroyed. Your savings become worth less and less. The dollars in your bank account buy fewer and fewer things. This is coming. It might not happen this year. It might not happen next year, but it's coming. The math doesn't lie. And if you know what to look for,
you can already see the early warning signs. Look at gold. Gold has nearly doubled in the last year and a half. Gold doesn't make moves like that for no reason. Big money, smart money, institutional money is buying gold because they see what's coming. They're front-running the crisis. They're protecting their wealth before everyone else catches on. Central banks around the world are buying gold at record levels. Billionaires are moving into hard assets. The smart money is preparing. The question is, are you? So what do? How do you protect yourself from what's coming? First, understand that cash is trash. When they print trillions of dollars, your cash loses value. Government bonds lose value. Anything that's a claim on dollars becomes worth less. So you want to minimize your exposure to cash and bonds. Second, you want to own real assets, things that hold value when money is being printed. Stocks are a real asset because they represent ownership in actual companies that produce actual goods and services. Gold is a real asset because it's tangible, limited, and has been money for thousands of years. Bitcoin is increasingly being seen as a real asset because it's scarce and can't be printed. Real estate is a real asset, especially if you have a fixed-rate mortgage, because you're locking in today's debt and paying it back with tomorrow's cheaper dollars. These are the things that protect you from inflation. These are the things that preserve your purchasing power when the government is destroying the currency. Here's the harsh truth. It used to be that you could just work hard, save your money, and retire comfortably. You could keep your head down, focus on your job, and trust that your savings would be there when you needed them. That world is gone. It doesn't exist anymore. Today, when governments manipulate the money supply, when they steal your purchasing power through inflation, when they financialize every aspect of the economy, you can't just ignore it. You can't just hope it works out. You have to become a student of finance. You have to understand how money works. You have to become an investor whether you want to or not. Because if you don't, you'll be one of the millions of people who work their entire lives only to watch their savings evaporate. Financial literacy isn't optional anymore. It's survival. Look, I know this is heavy stuff. I know it's scary to think about. But here's the good news. You're here. You're watching this. You're learning. You're ahead of 99% of people who have no idea what's coming. Just keep watching these videos. Hit that subscribe button if you haven't already. Turn on notifications so you don't miss anything, because the information I share here could literally save your financial future. The next crisis is coming. The sovereign debt crisis is real. The government is running out of options. And when it happens, it's going to be bigger than anything we've seen before. But you don't have to be a victim. You can prepare. You can protect yourself. You can even profit from it. The choice is yours. Thanks so much for watching. Stay smart, stay informed, and I'll see you in the next video.